Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're active or passive, you're in the industry, well, the Gray Report is the YouTube show and podcast that was designed especially for you in order to keep you informed and up to date on all the latest happenings, research, reports, data, articles, and throwing out some opinions related to the multifamily industry, but also real estate and just the macro economy at large to help you make some really good and informed decisions. Again, whether you're an investor or you are just in the industry itself. Got Matt Bosnagel, Director of Communications and Marketing over here at Gray Capital with us today. Got some really interesting articles. Again, we're going to be talking about recession. How does multifamily work in a recessionary environment, but also reports from the National Apartment Association, NMHC, and the National Association of Home Builders, RealPage, Moody's, a lot more. Let's get into it. All right, bringing it back in. Again, welcome back to the Gray Report. Make sure you're subscribed to the Gray Capital YouTube channel or you're hooked into the podcast. And so that way you can get updates every single week. We release a new episode of the Gray Report every single week. And that comes with the Gray Report newsletter that you can sign up for at graycapitalllc.com/newsletter. It's got even a lot more articles, reports that we can include on the YouTube show and podcast. So go check that out, graycapitalllc.com. Subscribe, leave a comment. Matt, let's get into it. But how's your week going so far? Lazy days of summer, but we got a lot of stuff going on.
Yeah, it's going pretty well. My kids, it's the first day of school. They're a little earlier than I went, but man, I kind of in the mood for school. Sometimes learning can be fun.
I would be interested in seeing a study, Matt, looking at apartment growth rates, the seasonality of apartment rental growth over time compared to the starting of school. And the seasonality has changed in the apartment market and other industries, because so much of the seasonality in many markets is related to kids going back to school.
Yeah.
And so I'd be curious of whether that is, pushing demand, earlier into the year, earlier into spring, and if that's shifted. So I don't think we have data on that, just some anecdotes, but I'd be interested in learning about that at some point.
Yeah, for sure. In the markets in general, there's I remember you sent something earlier. I think it was like a social media post where a guy was talking about how much you don't need to be this wild winner, how years and years of stable growth, of stable wins, maybe not number one, maybe you can be number 3 or number 5, but you want that stable growth. And this is what I've been thinking about for this past week, is how you kind of looking for security, and you don't need to kind of flail wildly and go into speculate on crypto or something. I think that people are much more thinking about stability.
I would 100% agree. Is they're looking for something that's going to work, and it's going to work over the long term, because there's a lot of uncertainty. Who knows what's going to happen in a year or two, but looking at over the next 5 or 10 years, you're going to have a much greater deal of confidence, at least what's the general direction of things. And I'm seeing that just talking to investors as well. I felt like there was a kind of a softening of just investor interest in to do anything, kind of like, I'd say April through kind of June, maybe early July. But for whatever reason, I think there's more interest on getting allocated, people deciding that they need to make some decisions and making the conclusion that multifamily apartments is where they want to be. I think there's also some considerations of wanting to get allocated this year for tax reasons, because people are selling a lot of things and they would like to shelter some of those gains with more depreciation and losses from acquisitions that take place this year, and also to take advantage of the fact that accelerated bonus depreciation is being reduced and phased out over time starting next year. So this is 2022 is the last year to take the full advantage of the accelerated and bonus depreciation. So we having quite a few conversations with investors who, they they don't want to make a decision just because of taxes, but they want to get allocated this year into the right multifamily deals. But
Yeah.
finding the right multifamily deals, that's the challenge right now because cap rates are still low, prices are still high, rent growth is still high, which is keeping the market competitive and buyers in the market. We haven't seen, I mean, we've seen hairline cracks in the market,
Hmm.
but we're not seeing, major cap rate expansion by any means. I mean, we were bidding on a couple of properties recently, Matt, that we were hoping that would trade for higher cap rates to see if we could pick up, a great deal and a good location for a good price. They're still at very high prices,
Yeah.
low four, high three cap range.
Man.
So still a lot of buyers in the market.
Yeah, it is. And in this and these series of articles that we're going to go over today and reports really showcase how robust the multifamily market is going to be even into the future. You could throw a whole lot at it, and things have been thrown at it, and it still does really well.
Yeah.
Um, it's not. It's. I'm not going to say it's invincible. But man, there are reports where that came across this week where I started to read him because I was a little bit scared, like, oh, there's some data in here that could be a little bit unsettling for apartment investors. But then you read the flip side of it, and actually, we're pretty well set up as
Yeah.
investors. So yeah.
And first, I want to get into the Moody's piece about
Hmm.
what would a recession mean to the multifamily market. But then I think we're then, or at least pretty short after that, going to get into the NAA NMHC report about apartment demand through 2035. So looking at some kind of near term
Hmm.
prospects and what's going on right now in a recession right now. But then what are some of those headwinds over the next
Yeah.
decade plus? Because there are some headwinds compared to the last decade that I think that it's important to discuss. But I think to your point, there's also kind of a silver lining to some of those, and that we are set up in a pretty good spot for multifamily, at least for kind of pretty stable growth. So,
Yeah.
all right, let's just jump right into this Moody's report. This is a really good one. Moody's Analytics. What would a recession mean for the multifamily market? They've got a lot of good statistics, a good write up. And the overall conclusion, and a lot of this is just looking back at history, but multifamily pretty stable, even in a recession.
Yeah. I again, and we've talked about this. I keep thinking about alternatives. Where are you going to put your money? And that's what you said too. When these people are looking to allocate their money into somewhere safe, and in an environment where kind of everything seems to be going down, multifamily is one of the rare places where you can achieve a little bit of growth, and or maybe mitigate your risk,
Yeah.
especially. They have some historical information about that, and then some real current information about where things are going. And it doesn't look so bad if things do go bad in the general economy for multifamily specifically.
Yeah. I want to highlight, Matt, some of the graphs and kind of the data that's in this Moody's report. Looking at real pr- real housing price growth and rent growth prior to the 2000s, and this is really kind of pointing at what was going on in some of these higher inflationary environments and eras of recession. Going back to the early 80s, where even we saw a short decline in home prices, like in about 1981, followed by a rise in home prices. We saw rents really kind of outpacing in climb during that period. And in general, I think what you're going to see from this report and others is that, compared to single family home, whether it's price growth, there's much less volatility in the multifamily market, and it's much less lumpy and much more kind of linear and smooth growth rather than a bunch of fits and starts. Um, but then again, comparing just how bad recessions have been in the past for the rental market and looking at kind of rent growth in those time periods, I think that again, this is illustrative of kind of a maybe worst case scenario, or what are those worst case scenarios
Yeah.
in terms of rent growth? Because I get asked this a lot of like, well, in your model, you're putting in a bunch of negative rent growth if we're having a recession, and but how much a decline would we actually look at? or because people say rents are very sticky, and I think this illustrates that they are even in a recession. So if we look at going back to 1980 through kind of the recession in 1980, it was a recession that lasted 8 months. We saw -8% of GDP growth. Unemployment rate at its peak was 7.8. The CPI inflation was growing at 14.6%. Lowest single family price growth. So home prices declined 3.4%. So when all this is going on, I mean, that's major loss of GDP growth, high unemployment, really looking at this stagflationary environment that many are concerned about today. The lowest rent growth that occurred during that time period was -2.4%. So really, not that extreme. Um, Now, during the Great Inflation of 1981 through 1982, we saw GDP drop another 6%. Unemployment was all the way up at 10.8%. So we're talking very high unemployment. Inflation was at 11%. We saw single family home prices decline by 5.3%. That's CPI adjusted. And then lowest multifamily rent growth. Again, these are CPI adjusted numbers. So in terms of nominal, there would have been rent growth, but with CPI and inflation adjusted, there was a loss of -1.8% rent growth. And that's not that bad, especially when you're considering that that is factoring in for inflation. Now, the worst period for rent growth was in the early 90s recession, kind of at the end of 1990 through 1991. It's a period that lasted for 9 months. We saw GDP shrink by 3.6% at its lowest trough. Unemployment got up to 6.8%. Inflation was running at 6.4% for CPI. Single family homes adjusted for CPI, -6.7. Rents were down 3% adjusted for CPI. And that's the worst time in the last 40 years for the rental market itself, was a decline of 3%. Now we're seeing rent growth right now nationally in the 15% range. So, it's relative for that 3%, and 3% is your typical organic growth assumption that we may have used, prior to the pandemic. So essentially, they lost a year of rent growth. Now, just kind of, there's the dot-com bubble that we actually didn't lose any rents. It was CPI adjusted. It was almost a year-long recession. GDP shrunk 1.6%. Unemployment shot up to 5.5. So not that bad. CPI was growing at 3.6%. So moderate inflation. Single family homes, they appreciated 1% adjusted for inflation. Rents grew by 1.5% adjusted for inflation. And then, even in the Great Recession, last 19 months, since 2007 to 2009, 8.5% shrinkage of GDP. Unemployment shot up to 9.5%. CPI was at 5.5%. Single family homes dropped by 14.9%. Not shocking. It was a housing crisis. Rents only a decline of 1.6%. And then obviously in the pandemic, we saw no rent losses either. So the conclusion, that was a lot of statistics that we were throwing out at everybody, but there is a lot of evidence here looking at past recessions for multifamily resilience during an inflationary time. And we're not even getting to the fact that after a recession, we typically see a significant amount of rent growth that typically washes out the losses during that recessionary period. So
Yeah.
I think really illustrates it now.
And if you look at the chart for the real housing price rent growth and real rent growth after the 2000s, you can see that after the year, I think now I've got to have to zoom in here. After around 2002, there were only two moments where rents went down, and that was between 2008 and 2010, during kind of in the wake of the great housing crisis, and then during the pandemic. After that, it has always been there's been consistent rent growth, and that's that's kind of like a 20-year period. And you have, and even those moments where rent growth did dip down, they didn't dip down very much. And you can look at the housing price growth really dipped down during those years. So what we see is a more moderate effect of any kind of price fluctuation in the rental market versus the nominal housing price growth.
Yeah, I think, yeah, man, I think this really illustrates how less volatile the rental market is versus the single family home market itself. I mean,
Yeah,
very stable. Though things don't always go up, so obviously there's some declines here and there, but they're they're kind of blips on the radar in context of
yeah.
the last couple decades. That's for sure.
Now, so that was kind of the past, and that was the kind of the context that we're going into it. And I still think that it holds true for this potential recession or actual recession, depends on kind of who's defining it. But they do single out 5 factors that are that can kind of guide us through how the multifamily market might fare compared to the previous recessions. One is a slower rate of new construction, which we've seen, and really we are still seeing kind of play out.
Hmm.
It still remains to be seen. There was some predictions say that we might have 450,000 new units by the end of this year.
So some
Some
500, yeah.
Yeah, some say 500, but it all depends on how quickly things can get built and how expensive they are, and whether these supply jams and materials bottlenecks and labor shortages, whether that has a more meaningful effect on construction than not. So the second one is a transfer of demand from to the multifamily market, which kind of has to do with a price to rent ratio, in that if housing prices are higher, such as a lot of people have talked about, the mortgage rates, making it harder for people to buy a home. Are those going to become renters? Now they also say, and I think that this is a good point, there could be aftershocks there where things could swing back very quickly. You've seen how, we just took a look at these charts, how volatile the housing price market is, and so that could swing back. And but I think though, right now, if you're looking at these charts, the price of a home is so much more than the price for rentals. I think that we have more room for rent growth. I think that it is also a big sign that if multifamily does well during a recession, just in general, we have a little bit more cushion because there is so much room between how high housing prices are right now and how high rents are.
Yeah, I mean, look at this chart of this is existing single family home prices to multifamily market rent ratio. Kind of the higher that it goes, the bigger gap between what it would cost you to buy a home versus what it costs to rent. And what we were most affordable, or sorry, the least affordable kind of in the 2011 range. That's because prices of single family homes had declined so much. So buying a home made a lot of sense because you could pick up a house for on the cheap. It's just the absolute opposite
Yeah,
scenario right now, where we're basically back at the levels in 2005 where housing is so expensive and renting makes a lot more sense. But to your point, Matt, and to the point that Moody's is making, the risk there is that if at some point housing will get cheap again, if that happens, there's so many potential buyers that are on the sidelines, many of which are just waiting for that opportunity.
yeah,
Now, depending on who you speak to, people are saying, well, they're never going to really see the opportunity that they really want. And even if prices decline, you're still looking at if interest rates are still high, which that's a question for how long they'll be at elevated levels. But can you still afford the monthly payments? Can you still qualify? And with so many buyers on the sidelines, any any material decline in pricing, or how quickly will buyers immediately jump in, ready to go. They kind of, which acts as a floor to the
hmm
housing market, because we have to remember that so many millennials are hunting for their first home right now. They're at peak home buying age, and they're having families and having kids, and they want to buy a house.
yeah.
And then another thing I think about is how many of those individuals will eventually just become, renters, for life because, they just missed out on that opportunity, and they're going to kick the can down the road so far that they're going to be a renter for at least the next, 5 or 10 years. And maybe they'll never buy a home. Yet
Yeah,
to be seen.
yeah, it is crazy. I mean, just looking at this chart, we are houses to buy a home. It's almost as expensive as it ever has been, and even in a very volatile situation, the home prices have have a long time to fall. It would be almost impossible to cut it, cut it down in 1 quarter or 1 year even.
Yeah.
So there's some cushion there, and I think that means maybe a little bit less risk, that we would see a downside. And if we do see one, we'll see it coming a long time in advance.
Hmm. Agreed. All right. So
Yeah.
Matt, we're
So
talking
the
about the recession. That some, I guess it depends on who you ask. 2 consecutive quarters of negative GDP prints. That typically means a recession. But we're talking about the here and now. So let's talk about this apartment list report. It's the July report for apartment list national rent report. So
Mhm.
let's just hop in and see what they're showing. Looks like continued growth, but definitely, I mean, we're kind of splitting the difference between, kind of 2018, 2019 versus 2021. It looks like
Yeah.
here in
Uh,
2022. So
rent
that kind of seems right, normal.
Yeah, I think rents up 1.1% month over month, 12%, 12.3% year over year. They are up at this point. It is 6.7% higher than it was in January, just for the year. And you can I was kind of eyeballing what each year would look like at this point. And yeah, I think we're a little closer to the historical mean, I think, than we are to 2021, but we are well above that historical mean.
Yeah.
Um, don't call it a cool down. I think that's like, I think if I had a sassy pop music single from the early 2000s about multifamily rent growth, that would be my name of my single.
What? Wait. What is
I
what?
would call it "Don't Call It a Cool Down," and then that would be
Oh,
my, I'd give a little
yeah.
sassy look. But
Nice.
I don't, that's because so many people are calling it a cool down, and it really is
It's like a
elevated.
cool down from a fever. So
Yeah,
it's like
yeah.
not a bad. It's like sometimes a cool down is a good thing.
Yeah, it is definitely moderating, and I do think that is important. It implies a greater stability, and there was something a little bit reckless and uncertain about how high the growth was last year.
Yeah.
This is a little bit more predictable. You can see the line itself is, just a little more stable now compared to the other years. So the line for 2021, of course, is the highest. It was 17.6 growth by the end of the year. At this point, at this point last year, it was 12% year rent growth year to date, just about. So that compares to currently what we're at is 6.7. So we're
Mhm.
about at half, a little over. But then if you compare for 2018 and 2019, which is kind of the much closer to historical averages, they were at 3.4 and 2.3% year over year rent growth by the end of the year. Because of seasonality, they were at about 4.5 and 3.5 year to date rent growth in July of 2018 and 2019. But still, we're about 2% higher than that. Is about 50% higher than either of those figures, than the bigger figure, really. So rent growth is well above historical averages looking at the numbers. And if I was trying to give the numbers for people that can't see the graph, but if you look at these lines on the graph, you get that idea without reading the numbers themselves.
Yeah.
2022 rent growth is gliding up and away from 2018, 2019. 2021, yeah, that's the dang rocket ship in comparison, but rockets are risky.
Yeah.
So I think
Well,
I'd rather be on a
in
glider.
context, again, 12%, that's 4 times the amount of a normal, what you would typically see in a year in terms of rent growth. So
Yeah,
we're getting 4 times the growth still in this year. We had over 5 times the growth in rent last year. So that's, I think, a little bit of normalcy. If 4 times is normal, is welcome to kind of get back to a more stable market.
yeah,
Um, Now, just another way to illustrate this, breaking it down month by month, month over month changes in national rent index. Again, and it's an important point. These are national numbers, so different markets behave completely differently. But there are some national trends that are worth paying attention to, and we definitely have an audience, Matt, that are in many different markets. You can see the big difference. I mean, 2022 looks, again, it's a splitting the difference between kind of pre-pandemic and 2021. It's almost, 2020 was such a wash year. Can almost kind of scratch it out, but certainly higher than 2018, 2019. But certainly nothing like 2021. What will be interesting is, for how strong or soft the latter half of the year in
Yeah.
Q4 is, because typically, again, we talk about seasonality, people going back to school. Season's over once kids really start going back to school, and you see typically in a year, rents would get a little bit cheaper in the back half, and starting in August, and certainly kind of peaking in November, which just then not a lot of people are renting apartments in December in general. Um, so in that kind of, you kind of revert not revert to the mean in a sense, from the growth earlier in the peak season during the summer. So it'll be interesting if we're going to see, a big shift to that kind of mean reversion starting in August, the month we're in right now. Now, anecdotally, across our properties in our portfolio, we're still seeing strong growth. I mean, the rates that we're renewing residents at apartments is incredible. Um, but I think we're going to see, we've seen, there's a lot of rent relief programs that are expiring, like that have just expired. And I haven't heard a lot of people talk about that, of where, a lot of municipalities were getting they got a lot of COVID money to fund these rent relief programs that you could qualify for, and they're going away. And I wouldn't say it's a large percentage of residents at apartments that were taking advantage of those programs, but it's definitely, 1 to 3% certainly were, and that was helping a lot of people continue to pay rent and not be evicted. And with the rising costs of everything, now people are going to maybe start to push back on some of these rent increases. We're not seeing it all so
Yeah.
far, but if it was going to happen, if we look back at the past for some kind of indication of the future, we're going to start to see some of these effects in the consumer being squeezed just a little bit too much, where we're not going to be able to accept too much, and owners will be willing to make some degrees of concessions given the seasonality, wanting to be as leased up as possible going into the colder winter months, where you're just not leasing nearly as many apartments. So that could be a big difference in the eventual average rent growth for 2022, is what happens in the latter half of the year. We could see that 12% up to 15% if we see relative growth, or we could be sub 10% if we see some major declines over the next couple of months. It'll be interesting.
Yeah. I think that the story about vacancy is also pretty compelling, and it also really maybe points to continued demand. We this has been the third straight month of stable, and this is stable at 5% vacancy. Um, Whereas at the beginning of the pandemic, it peaked at 7.2. The lowest it was at was 4.1%. We're a lot closer to that 4.1 than we are to that 7.2. The historical pre-pandemic vacancy levels were around 6%. So we're definitely lower than we were before,
Yeah.
and I don't see any reason to think that it will continue, or that it will go higher. I mean, 3 months of
Yeah.
stable at 5 is pretty good.
And I'd point to the single family home prices as being a major driver of this. Is just that there's so many people who just need to rent right now, just
Mhm.
because buying isn't affordable. So yeah, I don't see. I think the rent growth is more a question than the occupancy, at least right now. I think we're going to be pretty well
Yeah.
occupied. Now, can people pay the rent? Or what are collections going to look like? And what can you continue to get for rental increases? Again, I think that we'll have
That
to
was
wait to see.
Well, and that was actually one of the points that they expand upon in the Moody's article, is how the changes in the labor market, and maybe a reduced disposable income could create that a ceiling to price increases, even if the demand is there. And we've seen this in the lower vacancy rates for Class C properties, even though their rent growth is actually lower as well. They just don't have that money to pay, even though the
Yeah.
demand is there.
I think that's been I think the one head scratcher to a lot of people is that we haven't bumped into a ceiling. I think everyone assumed that there was a ceiling like 150, $200 of rent increases ago.
Yeah.
But that ceiling exists. It's not as though you can continue, that the consumer can absorb an infinite amount of rent
Hmm.
increases, because certainly the incomes aren't rising at that level. There's different reports on wage growth. There's some reports like the one that RealPage put out saying that kind of the rent income ratio is basically almost unchanged pre-post pandemic.
Hmm.
There's other reports saying that wage growth is really lagging behind more so than most kind of recoveries. If we had a recovery, um, there is, I think, evidence in itself that it's not directly correlation, but the fact that we have been able to achieve these rent increases does relate to the fact that we haven't hit that ceiling because
Yeah.
people are qualifying. Um, but so that ceiling still could be out there, assuming that it is. And as the price of everything else is increasing along with rents, I think we could easily be approaching that point of where it's like, hey, we just can't move that much more further. We can accept this. Maybe it stays sticky and it maintains, but again, multiple years, 4 to 5 years of rent growth in a single year. How many years can we do that? I
Yeah.
mean, because then we're growing, decades over a couple of rent growth in a couple of years, and that's now you look at other countries across the world, and you may see similar kind of rent to income ratios, and I think we're still a cheaper place to live compared to other developed countries, but you know, there's only so much that you can move it to some
Mhm.
degree.
Yep. There's a housing supply problem still, and I think that it is still enormous. Yeah. So, and it's
Agreed.
important. You got to find somewhere to live, and I think that that may be one of the chief factors here is that during the pandemic, people realized how much they were willing to spend to
Yeah.
improve their living situation. Now, if they now that is maybe a little bit driven by preference. And once there's kind of hard limits on what they're able to spend, then maybe that'll go down. But it is interesting how that sentiment, the value of the home, has it really increased during the past 2 years.
That's a good point. Yeah, no, people are definitely putting a priority on their space, their home, working from home. It's more important rather than, hey, it's a place I could keep some of my things and then I'm out at work, I'm out, doing things.
Yeah.
People, they value that space. The last piece from this report, Matt. No, this is not a map of monkeypox outbreaks. This is rent growth from March 2020 through July 2022. Um, it's a lot. Again, the many areas across the Sun Belt, deep red. You were seeing mid 30s in terms of rent growth, throughout Florida, as well as some areas of Texas, San Antonio 22, Austin 28, parts of Fort Worth and Dallas kind of in the mid 20s. I would hop on to the Gray Report, grayreport.com. We've got a link to this. You can kind of have fun and explore this whole report, see all these different markets and what the rent growth is looking like. Again, there's some really strong markets in Indiana, like Carmel at 41.7. And again, I just like to point this out to people. Um, because Central Indiana doesn't get talked about as much as some other markets, but we're actually compared to even like Texas, which is like people think is like one of the better markets out there in terms of rent growth. A lot of the markets in the Indiana are growing at faster than many of the Texas markets, and on really kind of on par with a lot of Florida markets as well. But you get Sun Belt growth for Midwest prices in some of these markets. That's why we like them. But
Yep. Yep. It's
so
true. And there's some real evidence that the Midwestern region has has a little bit more strength and staying power when it comes to these things
definitely
than
more
other markets.
stable. Definitely seems more stable. Matt, you want to talk about carried interest loopholes? A little wonky. I don't want to lose the viewers, but we also have a pretty sophisticated viewer base. So
That's right. A couple of questions that I asked when I was reading this, and so I had to do a little bit extra research, and I was like, what does this mean? Firstly,
yeah,
what
yeah.
what the heck is going on here, and secondly, what are the real kind of implications? And so, just as a little bit of background, and Spencer, please feel free to jump in and tell me if I'm wrong here. But I actually I heard more than one I read more than one article and heard more than one podcast about this issue, and all of them noted like I'm probably going to lose a couple people here, and so I'm not sure if anyone really fully understands it. So that's
Well,
the caveat.
now you got people really excited to tune in.
That's right. I love it. As a little bit of background, in 2017, as part of the Tax Cut and Jobs Act, they added this section to the tax code, which extends the holding period for certain carried interests from 1 year to 3 years. So what it basically means is this carried interest, which is how which is the interest that goes on top of what a private equity fund or investor would pay to the LPs so that interest, that extra interest, is called carried interest that a GP or a syndicator would receive as part of their doing business. Now that is taxed at a long-term capital gains rate now, but if this new law would come into effect, it means that we'd have to wait 3 years in order to qualify for that lower tax rate. My understanding is that if this extension goes into effect, real estate investors would, particularly syndicators and like sponsors of the deals, would pay a larger tax rate for the first 3 years, and all the years thereafter will get taxed at the lower tax rate.
So what is this? So what is it? So let's talk about maybe what this means.
Okay, yeah.
So I think you can see this leading. One, I don't think this is going to happen. I mean, we've talked about this carried interest loophole probably I think 3 or 4 times on the Gray Report that it hasn't happened.
Yeah.
And Peter Schiff, you have whatever opinion of him that you want. He made a good point on his podcast recently talking about this carried interest loophole. And is this again, because the total money it's going to raise isn't that much. I mean, it's like $10 billion or something. I want to say off the top of my head. We're not going to fix a deficit with this loophole. You are penalizing the allocators of capital in private equity. He'll say it's just Wall Street and hedge funds, but it's how the allocators of capital in a society, capital is allocated in a capitalistic society. What's really going on is the thing about the timing here. This is right before a midterm election, and the Democrats, who aren't in a great position to retain the House, maybe even lose the Senate, they need the largest war chest that they can have. And why not extort some tribute from Wall Street by threatening to eat into their profits of throwing this out there? The donations are going to roll in, and then what do you know? Carried interest loopholes can get dropped again. A little bit of a conspiracy theory, maybe true, maybe not true. Point is, I'm skeptical that anything's going to actually happen with this. All that aside, though, the biggest effect, one, raising taxes in a recession isn't usually the best practice for the economy. You could argue that this would have less effect on ordinary Americans, though, outside of the secondary and tertiary effects. But again, we'd be looking at, I think the effect would be longer hold periods potentially for some investments, real estate and non-real estate. But if I'm a syndicator and I'm looking at if I sell something in 2 years and I'm going to pay a higher tax rate than 3 years, the same reason now why people will hold a property for at least 1 year rather than less than a year, so they can get taxed at long-term capital gains versus ordinary income. Now let's say, well, hey, I'm going to not just wait for a year, even if I'm kind of flipping it around. The new short-term hold, instead of maybe 18 months, it's going to be a full 36 months because they want to wait for that lower tax rate.
Yeah, there's some indirect effects that I could see. Maybe it could be this increased tax could be passed on to the renters, and make it harder for people to rent.
Doesn't really work that way.
Well, if you're calculating your profits and you want to maintain, that same amount of profit, they could account for that. I also think
this is like the splits, like your equity split, your promote, or the carried interest, and it's not as like margin. Like, it's down the road related to margins, but a private equity investor is going to be trying to maximize the rents and the profitability of the project. I don't know how much more like you could push rents because
Yeah.
you're worried about your carry being taxed at 20% versus 35%. I don't think that's going to happen.
Yeah, it could disincentivize investments in general, and
It could just that I think that's they could just de-incentivize investments in general,
and
100%.
what I'm really thinking of is if you're a developer, and you're trying to find an investor, well, if they're less interested in investing, then maybe that means less new apartments get built.
Well,
And
it shouldn't matter to the investor because it's not any tax that they're going to be paying. It's only on the promoter or the sponsor. And so what you could see this as you could see sponsors increasing other fees. They could adjust their splits instead of using like a 70-30. Maybe they're doing 65 65-35, but you have to get away. But I don't know if they'll be able to do that if investors will go for that. Instead of 80-20, it's a 75-25 split. I think the market, will adjust. It is going to incentivize again, capital allocators. But again, I don't really think it doesn't fix the deficit. Yeah, it doesn't really do much good, and I don't think it's going to happen. So,
yeah, I still think it is worth kind of talking this out. And as much as we've seen this happen, through the Build Back Better discussions and all that kind of stuff, it's worth considering what could happen, even if it's not really the time to worry about it. You can talk about it, maybe speculate, but I think it probably is a waste of energy to really be biting your fingernails and worrying. Really,
yeah. I mean, how much time? I mean, how much time did we spend in 2020 talking about all the tax changes that were certainly going to happen, and that none of them happened?
Well, and I could be wrong there. I think there were a couple investors or some that we talked to specifically that were like kind of sitting on the sidelines, and they were like waiting for something to happen because they were so worried about these legislative threats.
Oh yeah, well,
investors.
everyone's like, I need this deal closed before the election. I need this deal closed before the election. I need this deal closed before the end of the year because I'm certain they're going to raise capital gains. And then people worrying about, well, what if there's like a retroactive, capital gains tax and all this stuff. None of it happened.
Yeah.
So it's good to watch, keep an eye out for the weather. And this does affect, our industry. It affects if you're a syndicator in the private equity world. And maybe it doesn't happen today. Maybe it happens next year. Maybe it never happens. So it's good to be aware, but I'm not holding my breath.
Yeah. Don't waste too much energy on it.
No. Okay. But here's one, that you can put some energy into, because this is a really interesting report that the National Apartment Association and the National Multifamily Housing Council did a joint study looking at what U.S. apartment demand is going to be through 2035. So, man, that's a long time to attempt to predict the future. But looking at some of these longer trends, headwinds, tailwinds, it's good when you're looking at a business plan that might last 10 years or so.
Yeah.
So
I think that this is one of the reports that I was most interested in discussing with you today, and it's one of these topics we've read a little bit of information about these kind of long-term speculations or long-term predictions. This study has a lot of depth and breadth, really more than I can give it justice to here. I encourage anyone interested to read it. It's called U.S. Apartment Demand Through 2035 by the NAA and NMHC. They've got some hard numbers here, and it's not just broad speculation. Maybe a little dry on some of these numbers and some of their conclusions, but very much valuable for sure, and rare in terms of you don't see this happen a lot. So I'm a little bit, though, admittedly, I'm a little bit chastened by the picture that they're painting. It says that unless we see some dramatic changes, apartment demand and housing demand could decline over the next decade. And this decline is due to a confluence of factors at the national level. The most apparent being slower population growth. The report cites the slowdown in population growth during the pandemic, but I think this issue is bigger than what's happened in the last 2 years. If you look at the charts that they have, you can see a consistent decline. Now, sometimes there's a bump up and a bump down, but really, in general, we have declined in terms of population growth for a long time. So let me just bring this up here, and so that I'm not talking without evidence here. But this, from really since 1992, if I have this correct here, the population has been kind of just consistently going down. The drop off obscures a more dramatic and meaningful decline really since that year. In 92, population growth was at 1.4%. It's gone steadily down since then. That's about 30 years, consistently trending downward. 2020, we had a 1% population growth. That was a huge spike up from previous years, but still not as big as it was in 92. From 2016 to 2019, population growth slowed consistently. Now, these are pre-pandemic years where growth went from 0.7 to 0.6 to 0.5, really to kind of to 0.45 before it shot up again to 1% in 2020. Now, 2021, it was 0.1%. So, it spiked up, but it spiked right back down. And I'm talking about slowdowns of 0.1%, but they're really a big deal, especially the fact that it's just this consistent trend. Now, through a lot of numbers, and I want to kind of close there with this quote from the report itself, which says that from the end of 2021 through the end of 2035, the population should grow in total by 5.5%. But the household growth rate over that same period is 10.6% because the household size is going to decline. This is expected to decline. This is an annual compounded growth rate in our base of 0.4% in population increase, so 0.4% growth even, and 0.7% in household increases, which is slower than historical trends when population historically increased by 0.6 in the last 10 years compared to that 0.4, which is expected. And household growth was 0.8 in the past 10 years compared to 0.7 in the next 10. So again, households and population growth may not be very strong. But to counterbalance that, and one reason why it's, I was chasing, and I think that these population growth numbers are really worth considering, really worth thinking about. But the housing supply crisis is so big right now that even even the enormity of these population numbers, it kind of just meets that almost like exactly in the middle. Now, kind of to backtrack a little bit, they do go through the possibility of an immigration and renter environment that would be more beneficial for the apartment industry. The baseline amount of new units needed, they predict every year from now until 2035 to meet demand, to have consistent levels of demand, would be 266 units per year. Now, we mentioned earlier in this podcast that maybe they might build 450 to 500. 266 is very doable per year through 2035.
Yeah, I think that's about the average of what we were building past couple of years. So
on their like high demand apartment demand scenario with more renters and more immigration, which they say immigration is actually one of these key factors to population growth. If we loosen up immigration restrictions and there are more renters, we'd need maybe 344,000 units per year. And then on the low end, we would need 175 new units per year. So those are estimates. And those are just estimates if we were to carry forward the current level of vacancy and demand. But what they also say is that we are at record low vacancies, record high demand, and what they call it is demand inconsistent with, it's almost like how we need a certain amount of unemployment in order for a fluid movement of people between jobs. And they're saying it almost as a kind of corollary that there needs to be a certain amount of vacancy in order to kind of facilitate the movement for people in their housing units. So with that in mind, to address this very high demand, an additional inventory of 447 to 747, basically an average of 600,000 units would be needed to return the market to vacancy levels that allow a more frictionless transaction market with more moderate rental rate increases. So basically tack on an extra 50 to 100,000 new units each year to bring demand back to normal, and you get to a pretty middle of the road expectation for the amount of new multifamily apartment units needed each year. So yeah, there is an affordability housing crisis, but there is a population slowdown that's coming. And I spoke about this when we covered some more broader speculations on this issue. But this is something that I really am thinking about. What if it comes to this point where, to address this housing crisis, we significantly overbuild, and where we have more apartments than we know what to do with, because we tried to address this crisis and we built, and then the population grows,
Yeah.
and suddenly we have more apartments than what we need. So
Yeah,
that's just,
we weren't building when we needed to, and then we build when we shouldn't be building.
yeah.
Is basically what you're describing. I think it's possible. I think the conclusion that I'm taking from this data is that, you can't look at everything on a national basis, and you have to be
Hmm.
very specific of which markets and submarkets you're targeting, because there's going to be incredible opportunities in many markets, in many submarkets and metros. But there are some markets are going to continue to grow, and some are going to continue to stagnate and decline.
Yeah.
And then watching, because I think that the gap is so big right now that it doesn't seem like we can overbuild, but you can very quickly get into a point of oversupply. And I think
Hmm.
there's already some major markets that are already at risk. A lot of people are pointing to that they're approaching a level of being oversupplied. And so you want to try to find that right balance of a market that is seeing good, steady growth, but is not seeing so much new inventory that's going to come online too quickly, or just too
Yeah.
much in general, that you're going to be upside down. So not painting with a broad brush, but really being more granular, which real estate is always a granular exercise. But just keeping that in mind is one way just to mitigate one of these headwinds. Because it's certainly a headwind for the market going forward. No doubt about it.
Yeah, that was what I was thinking too. Is like, one way out of it really is, don't, maybe not pay attention so much to the national level. Look in your own backyard, or look in those backyards where growth is really happening, because whatever slowdown is going to happen in the next 10 years, I can guarantee you that there's going to be markets and submarkets that are growing like wildfire. So that's what you need to pay attention to, is to kind of find those areas within the general, perhaps, slow.
Yeah, that's where you want to be. All right, Matt. NAHB, buyers' expectations of housing availability improve.
Yeah, so I kind of paired this with another article, also from RealPage, about declining consumer sentiment, and it seems like people are pessimistic. But that is the solid takeaway for this report. Yes, it is getting easier. So yes, their expectations of housing availability are improving from 17% to 22%. But if you look at this chart, no, they've always been pessimistic about buying a house.
Yeah.
Perceptions are not necessarily as concretely meaningful as actual behavior. At least 60% of home buyers have been pessimistic, since however long that they're measuring this. So at least think that
There's always a housing bubble, and we're always at the edge of the bubble.
we talked about how even during record low mortgage rates, there were people that were worried that mortgage rates are going to go up, or that there were people thinking that their mortgage rate environment was a bad environment. People are always worried about the future, and people always, maybe rightly so, when you're talking about buying a house, yeah, it's a hard decision to make. So I think that if we really saw their feelings and their perceptions matched up with their activity, we'd see people flooding into the rental market. But we don't. And I still think, though, that the trends are interesting. If you kind of zero out that baseline of pessimism, then the 5% increase in positive feelings about the home buying market is more meaningful. Especially interested, and this is where I was noting how the Midwest may be a little bit of a different environment when it comes to the home buying market specifically. There's this comparison between different regions in America and their attitudes towards buying a home. For the Northeast, South, and West, positive attitudes spiked in the first quarter of 2021, and they sank after that high point, and then they kind of trended upward in the past quarter. The Midwest is a clear outlier here, though, because home buyers here are consistently pessimistic. I'm sorry about that. Yeah, it's their positive feelings about buying a home went down slightly as the other three regions went up in the first quarter of 2021. So instead of going up in this past quarter as well, Midwestern home buyers are more pessimistic about buying a home. These Midwesterners can't catch a break. But what I really do think, it's hard to like pin down what that is actually going to mean. But you could argue that a tighter housing market in the Midwest, or that people in the Midwest are more likely to spend more on a home because they don't want to be caught in a worse situation. And I get it. I wrote this in my notes for the following article, but this is this classic kind of inflation mindset where, yeah, they are worried about things getting harder. So that's perhaps going to incentivize them to pay more today because they think that tomorrow it's just going to be that much more expensive. And so that kind of squares the circle when it comes to people, all these articles about, oh yeah, consumer sentiment is down, but they're spending more. How can it's because they're worried about the future. And that worry could result in.
Is it that? I think it is that, but it's also they're spending more, but they're getting less stuff for what they're buying. And like, yeah, they're spending more on groceries and gasoline and rent. They don't have money for any of the luxuries, so they're getting less stuff for the money that they spend. So the money's being spent, but we're getting less stuff. And then I do think that sentiment, if you have a negative sentiment on housing in terms of affordability, you're just going to the default, which is renting. Like if you're
Yeah.
not if you're not convicted that I'm going to buy a house, it's the time to buy houses now, you're just going to go to that default, which is renting an apartment or renting a house.
Yeah. Again, like I think that they're a lot more bummed out than they actually, if you made them make a hard decision, maybe they would suddenly realize that, okay, maybe it's not going to be that hard. But I still think that if you expect prices to increase tomorrow, then that will incentivize you to buy today.
But are people expecting prices to increase tomorrow for housing?
I think that in the South, Northeast, and West, they're not, but in the Midwest, they are. At
Because
least that's how I interpret that.
Yeah, because most common conversation is talking about prices declining and like, oh, it seems like it's in a bubble, and being pretty pessimistic on future growth of housing.
Yeah, well, I think that's why their buyers' expectations of housing ability have improved on the national level. But it's just that Midwest is an interesting outlier, and I wonder, I kind of wonder what the reason is.
That's because they know our housing markets don't crash.
That's right. That's probably right. And you see these long-term, it's not just in the pandemic where their housing sentiment was a little bit more stable than these other ones. You see a little bit more spikes in the other regions compared to the Midwest, but it's just reading the graph there.
Reading the graph. Just hard data. Okay.
Right.
More data and some interpretation from Jay Parsons from RealPage. How will declining consumer sentiment impact rental housing? Well, let's keep talking about this, Matt. I find this to be a humorous picture. If you're watching on YouTube, I don't know. I want to give this guy like an Eastern European accent. Let's see the houses.
That guy does not expect housing situation to improve in the next month.
It's very dire. Yeah, not good. He's got the pen out. They're doing some budgeting. Anyway, enough of the stock image commentary. What I really like what the pieces Jay Parsons has been putting out. Really kind of digging into the data and also giving us his opinion. Matt, you want to?
Yeah. He's really been, I really like, these past few weeks have been some good, interesting insights into the economy, into the multifamily market. So he also talked about this, what they call it, this gap between sentiment and behavior is the widest I've ever seen, said Moody's Mark Zandi. But the breakdown is actually really interesting. It says Americans keep spending on luxuries like dining out, taking big vacations, and buying new cars. This suggests that most consumers are spending on nice to haves. This also aligns with steady rent to income ratios that we've observed among market rate renters and credit card delinquency remaining below normal. At the same time, they're cutting back on things like groceries, furniture, and electronics because food inflation has far outpaced outpaced other categories. I think that this gap between consumer sentiment is like, uh, I do think that some of it could be motivated by the expectation that prices will increase, so might as well buy now before it gets expensive. But one thing that he says is perhaps inflation is just an annoyance that puts a people in a sour mood, but hasn't really affected us. It makes life a little bit bad, but it doesn't make it catastrophically bad. I would disagree just a little bit because you know a small number to one person, maybe most people have, it's impacted a little bit, but then there are people that are on the edge, and that could be a catastrophe.
Yeah, there are there's subconscious decisions of spending less, but then also at the end of the day, like if you have $100 to spend on groceries, if you have like $100 in your checking account and you only have a debit card, you go to the grocery store, like you're not buying more than $100 of groceries, and that
Mhm.
$100 is going to buy whatever $100 worth of groceries is worth. It may have bought you those groceries may have cost $50 last year, but you're not having any nice to haves after that point. So
Yeah.
yeah, there's no going over that. So yeah, I disagree a little. I think Jay part has been taking a more optimistic viewpoint, which I think is great. Love reading some optimism, specifically like his piece relating to incomes and rent growth, basically saying that like, look, no, incomes have risen right along with rents, and we got a lot of room to go. And again, that's backed up by what we're seeing in the market. But that is counter to some other data that we've seen that incomes have significantly fallen behind inflation and rents. And they really haven't benefited from the recovery. So there is some conflicting data out there, and I think we just need to continue to read a variety of different sources and opinions and make our own conclusions. I think it's somewhere in the middle. To be honest, I think incomes are certainly rising. I mean, I know people are making more anecdotally. I mean, there's tons of anecdotes, and then there's
Yeah.
data kind of pointing either way.
And I like this their kind of summative comments, his summative comments at the end, and it says, we're seeing some dire outlooks circulate, and this kind of touches upon a lot of what we were covering today, almost a lot of different like worst case scenarios.
Yeah,
Um, it says we're seeing some dire outlooks circulated, but our baseline view remains that rents grow materially, though below recent peaks, even as demand moderates, in line with our outlook going into 2022. History tells us that rent growth remains elevated during periods of inflation, which occurred in the 1970s and early 1980s, even amidst three separate periods of economic contraction. So it's not out of the question that rent growth could continue even in a stagflation environment.
yeah,
And then if you also factor in the increased investor intention and the search for the search for a place to allocate your money in a risk, in a lower risk, kind of like a sanctuary for multifamily or for market volatility. Multifamily is a good place to put your money. Thinking of it as kind of an alternative to to the craziness in the stock market.
I agree. I know 100%. There's only so many good opportunities out there, and so many stable markets you can go. Well, Matt, this was a great report. I recommend everyone who is interested in learning more about multifamily real estate, the multifamily market, to hop on over to graycapitalllc.com slash newsletter. You're going to be able to sign up for the weekly Gray Capital newsletter, packed full of even more reports, market updates, facts, figures. All we need is your email address and maybe your name. So hop on over to graycapitalllc.com slash newsletter and get signed up. And while you're there, after you sign up, check out the new Gray Capital website. It's been recently updated. You'll be able to learn more about Gray Capital, what we're all about, what we do, who's on the team, what types of properties we target. Maybe even take a look at our current portfolio. What type of assets is Gray Capital invested in, and then maybe look at, hey, I want to learn about some of your full cycle projects as well. Wow, you guys have done a lot of good deals. I want to learn about the ones that you guys have sold. What kind of returns? Take it a step further, look at our case studies, and then go even one step further than that, and if you're an accredited investor, you can learn about investing with us, whether through the Gray Fund or through a direct investment opportunity. You can check us out. And if you want to go straight to the fund page, you just type in your browser, gray.fund, learn more, fill out a form to get the full deck sent over to you, or just create an account on the Gray Capital Investment Portal and make your investment today. Again, if you are an accredited investor. So, Matt, what do you think? Should people go hop on over to graycapitalllc.com? Place to be.
Yeah. Oh yeah. That's gray.fund. It's so easy.
Oh,
It's
yeah.
so it's so beautiful too. Just take a stroll, take a scroll. You'll love it.
And leave your comments on. I don't know. You can just put the website comments on the YouTube page. I don't know, wherever it makes sense. Or everyone, we appreciate you watching this latest edition of the Gray Report. We will be back on next week, keeping you up to date of all of what's going on in the multifamily industry. We'll see you then.